welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Joe Austin of our corporate affiliate, Chaikin Analytics.
Joe is a very smart guy and a very experienced guy. He's got a lot of wisdom to share. Get your pens and pencils out, take some notes. So let's do it. Let's talk with Joe Austin. Let's do it right now. Joe, welcome to the show. Glad you could be here.
Thanks, guys. It's great to join you.
Our listeners are unfamiliar with you, Joe, so maybe let's talk about how you got here. They should probably, I'll tell them up front that Joe has been with Chaikin Analytics for about a year now, almost a year, and so is technically a colleague of ours. I would consider him, but you've had quite a career though. Before that, long before that, starting in what, the 80s?
Yes, sir. Thanks, Dan. So I started in the business in 1984. I worked at Bankers Trust Company, the big money center bank, and I started covering technology in 1985. And I covered tech through at various firms, basically through around 2000. And then I segued more into managing investment management businesses, and later on working in hedge funds and private equity. And when I met Mark probably December a year ago, and he gave me a test run of the power gauge to look at, and it really spoke to me. It was very powerful. When I worked back in the 90s, I worked at AIG, the insurance company, and we used a system that was very analogous to the power gauge in terms of picking stocks. So when I saw Mark's system, I instantly recognized what a powerful tool it was for ferreting out good investment ideas.
Yeah, Joe, Mark, of course, has been on the show a few times now, and he's a wonderful guest, great guy. I've really enjoyed getting to know him. But I'm always afraid that when we have him on, it's going to be, it's not going to be too exciting for the listener, because I spend the whole time going, wow, when he talks about the power gauge, and everybody has that reaction. Everybody's like, oh, wow, because it's quite the powerful tool. So tell me, do you now, since you've been with him, are you working on the power gauge itself, or do you use it as a tool? Or...
Yeah, so I as I said, I recognize it's a very powerful tool. And first, little bit of background myself. I've always been a fundamental analyst. I think things like the economy and macro and what's going on in the world are certainly very important and interesting, but I've always felt my time is better spent looking from the bottom up at the individual company fundamentals. And I see the power gauge as my co-pilot. It's a powerful combination of both technical factors and fundamental factors. And I think blending the two tells you a lot about what's going on with the stock. So I usually mostly to find new ideas, certainly ideas for our readers, and also to monitor existing ideas, because the power gauge is really great in telling you, what the setup is for a stock, but also it's great at telling you when things have changed. And as you know, things do change, and it's important to know those changes in terms of managing risk. So it's really, for me, it's something that sits by my side, and it doesn't drive it does drive every decision I make, but in a way where I think it's complementary to doing, you say, look, you look at it and you go, this is a great idea, I'll do some more work. And sometimes that plays out and sometimes it doesn't.
But it sounds like no matter how much more work you do, if the power gauge says no or sell, you are highly reluctant, to say the least, to get in that stock.
Yeah, it's really hard to argue with a lot of things it's telling you. For instance, I think some of the readers may know about the money flow. And I always say that as football is played on the line of scrimmage, stock prices are set on the floor of the exchange. And big institutions don't move big dollars around unless they've got a good reason to do it. So when you look at something like money flow, it's a powerful way for you to know the buyers and sellers, the ebb and flow and the supply and demand for a stock. And that's an important tool to understand what's going on.
So I guess if I wanted to push back, I could say big institutions move large sums of money around for dumb reasons sometimes. But it sounds like the important thing is they're moving the big sums. Their motivations are almost um, a side issue, right? To know that they're moving the big sums, to know that the price is being affected, things are changing. Like that's the point of it, no?
Yes, and with the money flow, you can see if there's what I call accumulation, or people buying the stock, or distribution, people selling the stock. So it's really not the magnitude at any one point in time, but just whether it's going on or not, what the directionality is. If I can find a company and think it's a great company, but if other people don't recognize that idea, if other people don't recognize that idea and buy it too, the stock's not going to go up. So likewise, if you buy an idea and there are 10 sellers around, that stock's going to go down. So it's not going to be a great investment.
So Joe, I have to ask, as an avowed, you said you really like to know what's going on with the business bottom up, and the gauge has a lot of fundamental factors in it. I still have to ask if you really are highly reluctant to sort of bet on a stock when the gauge is not with you, why not just put the gauge in charge altogether and not worry as much about doing bottom up research?
Um, it's a combination of the two. The
Okay.
power gauge gives you an idea of which way the wind is blowing, and it's your decision as to whether you go along with it or not. I have found it's mostly, in my now 18 months of using it, I found it's best not to go against it. And there are things like the industry group, which are important too. But in the end, no system is is infallible. You have to use things together. And the power gauge just gives you a great context to work within.
Okay. Gotcha.
Yeah, I remember when I first met Mark too, and talked to him, and he was explaining the power gauge to me and ran through it with me, and same thing. It was after COVID, I think, and he showed me. I just went through it, and there was like a Greek shipping stocks that were like super bullish, and I would have never like identified that just waking up in the morning on my own. That led me to like, oh, why is that happening? And then from there, there's all kinds of different ways you could do it. I honestly, we're fortunate to have access to it. I probably don't use it as much as I should myself. So.
I'm glad you brought that up, Corey, because knowing what I know, especially about how they structure those companies, like the power gauge could scream buy at me for a Greek shipping stock, and I would say, no thanks.
Yeah.
Even if it went up 200%, I would be like, I'm fine without that 200% because, these companies are so weird.
Yeah. I'll tell you another example that likes airlines right now. It's giving
there you
recommendations on 3 airline stocks, and I don't think I will ever buy. I like to fly on an airline, but I'm not going to buy their stock. So it's just a kind of a thankless industry. But that doesn't mean it's not a good trade. It's not a good decision. It's just telling you what it's seeing at that point in time.
Right. So your experience, in other words, is valuable to you. You use your experience. Like you're not just letting the power gauge tell you where to look and what to do. It's as you pointed out, a genuine combination. It really is just a tool for you.
Yeah. For me, investing is all about pattern recognition. Have I seen this before? Have I seen something that looks like it before? Have I made money like this before, or have I lost money before? It's all remembering those patterns and really looking at that. And the power gauge is a great, as I said, a starting point for all that analysis.
Okay, so let's dig more in there, Joe. Let's if you and I were just met at the bar or whatever, and we're clinking glasses and talking, and we turned to finance, and I said, like, what kind of an investor are you? How would you describe yourself as an investor?
So in my career, I've worked for everything from full-on growth stock investors. We don't care what the multiple is, to deep value investors. I worked for a distressed debt shop where we were activists and we looked for deep value situations. So I worked the spectrum. I would say on that range, I am more of a growth investor than a value investor. I see innovation as very important in terms of what I want to own. And I'm very focused on what I call owning the best horse. I feel like with a diversified portfolio, you don't have to own a little bit of everything. You don't have to own 8 insurance companies. You can pick the best one and find that. So what my style of investing is I'm also, I want to say this, more of a long-term investor than a trader. I've never been good at trading, short-term trading in stocks. So I'm looking for things that I think are going to play out over at least 6 months to a year, if not longer. And so I'm looking for the best horses that'll play out over time. And usually that leads me to more of a growth stock type mentality.
I see. So right now, then, I would assume, correct me if I'm wrong, AI has to be a serious theme for you.
Yes, it's huge. I view, started covering tech back in 1985. As a point of reference, Microsoft, I think, came public in 86. I was at Bankers Trust Company. I recommended what was then a hot IPO to our investment committee, and they rejected me. But anyway, they said it was a pie, flash in the pan.
Oops.
So we didn't get the first.
That was the internet, right? Somebody said that, right?
Yeah. But I see AI as analogous to the PC, the web browser, the smartphone, in that I see it as a disruptive technology. It's going to change everything. And I see basically my view is there are 2 ways to play it. Number one is you can buy the tech companies themselves. You can invest in what I call the horse race or the arms race of AI. Or you can look for companies that are using AI within existing businesses to change their business. And I'm particularly focused on the latter because I think, picking the best company in tech, even though I've done it for a long time, is very difficult to do. But taking a business that's been around for decades and is a great performing business and making it into an even greater performing business is probably a more safe way to invest in the trend.
Right. I agree. Yeah. You look at the places where they've already got a great business, but how is the use of artificial intelligence going to transform them? And are they already doing it? How far along? Yeah. That's sort of where we are, Mike Barrett and I, in Extreme Value. Because we want the great businesses anyway, which sounds like that's where you're focusing too. As soon as you said that, I smiled. I was like, yeah, I want the best one too. I want the best insurance company and the best software company and everything. But I wonder though, I'd like to learn to think about impacts on existing industries and companies and stuff. Like the company that I keep rolling around in my head is Accenture. Do you know that company? Accenture. Yeah. So when I think of Accenture, and I'll just read a little bit of the blurb just for our listeners, like Accenture provides strategy and consulting, Industry X, song and technology and operation services in North America, Europe, Middle East, Africa, internationally, systems integration, application management, security. It's a consultant. It's an IT consultant, right? So do I replace Accenture with an AI powered tool, or does Accenture become the owner of the best AI powered tools in the world? I'm scratching my head and I'm leaning towards the former, but why not the latter? I don't know.
Yeah. So I haven't really looked at Accenture expressly. Mm-hmm. What I did though is I took the Russell 3000 and I divided it into industry groups, into each individual industry group.
Yeah.
And then I took the top 10 companies by market cap in each industry group. And I went through their investor presentation, their 10K, and kind of did a web search about how they were using AI. And what I found is some industries were much more prone to AI than others, i.e. in medical equipment or medical technology, there's probably a high potential for AI to have an impact. In Pepsi or Coke or Taco Bell or something like that, probably not a huge impact on AI, though they could use it to target customers. So you have to really consider both the industry the company's in and the company's strategy within that industry to understand whether AI can have a big impact. A company like Accenture, I see them, from what I know about it, they would be more prone to help their customers understand how to use AI, or how to strategically implement AI into their business. And then Accenture, I think they'll probably use it to lower costs and keep themselves out of trouble. Will probably they use AI more than anything else.
Right, they're gonna lower cost, as in get rid of the the low performing tier of consultants, right?
Probably so. Well, it's not just that, but it's about what we're seeing in some companies today is AI is used for benchmarking. I've just written up a company for the Chaikin subscribers where we talk about a company that is using AI to help you monitor what all your competitors are doing. And they're rolling that into their user base as a way for their customers to save money and optimize their business. So a company like Accenture can look across different businesses and understand where the efficiencies are or the inefficiencies are. And I think that's the kind of thing they'll probably use AI for more than anything else.
Right, makes perfect sense. And there's something to the idea of them being like a educational firm almost. They're like you said, they're going to teach everybody how to use this, because obviously the term AI is this broad encompassing thing, but when it comes down to an individual business, there's 1,000 1,000 or more decisions and inputs and a process that takes time, weeks, months, years, I don't know, depending on the size of the business, to implement. And by the time you've implemented, everything's changed again. So maybe that's what we're.
And I would argue with AI, we're still in the early stages of adoption. I mean, it's been around 18 months, and it's been around for not 18 months. It's been around for a couple of 3 years. And I know at least last year, it's the only thing anyone wanted to talk about. But remember, the PC first came out, and John Akers, the CEO of IBM, thought it was a joke. He sat down at one day and said, this is a great toy, but no one will ever use it. And it took, I would reckon 6 or 8 years before anybody started saying, wow, PCs are really great. They're going to change the world. So I think we're still at the early stages, and it's not a binary thing either. It's not like you pass or fail within 3 months. It's something that someone could have an idea tomorrow that takes 3 or 4 years to play out in terms of corporate strategy. So we're in the first innings.
One of the simple, sort of obvious things I've learned about it is that from the very beginning, the most primitive computer languages, like somebody early on found Gigo, right? Garbage in, garbage out. So when the academic paper that came out called ChatGPT is bullshit, that was a real academic paper, and it made the point, it's like you're highly informed but otherwise kind of not so bright, relative maybe at the table in Thanksgiving, and they seem to know facts about everything, but they put it together in ways that are questionable. And that's what ChatGPT does, right? It spits out wrong things all the time. But that's because we're asking it general questions and it's searching the entire internet. But if you put it on the right, data and feed it the right data, like I know people in our business who are equity analysts who feed it 10Ks and 10Qs and then ask it questions about the 10Ks and Qs, and it can go through and find those things and give you those insights very quickly, rather than making you read every word of it.
Yep, and I also think as you point out, everything depends on what I call the data set.
Yep.
The AI model learns based upon the data it has. I actually see this as another opportunity for our readers in looking at companies, particularly in a vertical market, with the best data sets in the business. Because there are people out there that are gathering huge amounts of data. And I think that will give them a real leg up in the business because they've got the best data sets from which to learn. And not everybody is equal in this regard.
No, they're not.
So what's what's an example of that you can share? The maybe just an industry
There's
where
a company in medical tech called Viva Systems. The symbol is VEEV. And they are kind of like an outsourced data provider to biotech and pharma companies for drug development. Now, Viva will tell you they don't own the data. If they're working for XYZ Pharmaceuticals, they're managing all their drug discovery, all their clinical trials, all these type of things. They don't own that data, but they have access to it. So they can use that data to develop a language model that looks specifically at drug development and discovery and drug approval. So to me, that's a particularly kind of powerful data set that really no one else can replicate, because they've got not only they've got the data from everyone in that field, and they've got more data than anyone else. So I think that's a great example of something.
We just I can't reveal the ticker because it's a brand new recommendation, but we just covered another very, very similar firm that has the largest data set of its kind in a different area in the pharmaceutical industry. Same thing. Huge data set of very high quality, focused on one area. It's mission critical information for pharma and government and all kinds of other research universities and things. And if you're putting a good AI tool on that data, you're going to get a result.
Yeah,
and you're going to get that result without a lot of massive capital expenditures, like you're building a copper mine or something.
Yeah, there's a direct relationship between the amount of data and the quality of the model. And I think the companies that are vertical, that go deep and narrow, are going to really, and they may not come out on top, but they're going to be very interesting from an investment standpoint at the very least.
Absolutely. At this point, we've had enough decades of potential for collection of data so that we can get some of these massive focused data sets. And I'm glad we got onto this, because you're right. Go deep, go narrow. That's a good, I hope listeners are making notes, because that's kind of a good insight, I think, that you've provided. Deep and narrow.
And it's sometimes it's in places where you don't expect it. I know a company we're not recommending right now, Snap-on Tools, an old industrial company. But as it turns out, Snap-on has all this diagnostic equipment that pretty much knows the maintenance and repair data on every type of machinery out there. So there's a company with a seemingly germane business and germane data set, but where AI could come in and if they were to embrace it, would be very powerful for not only them, but for their customers too.
Yeah, another one is massive insurance companies, right? The underwriting at some of these is really pretty great. And how does it get better? I don't know, but they've got the data, so I guess we'll find out in 5 years. Who's able to. I don't know. I'm not saying they'll make great strides in underwriting, but you never know. The data's there. We'll see what they do with it. Another one is one of my very oldest pick that's still active is ADP, and of course they have data on they hand out everybody's paycheck every week or whatever, and they direct deposit everybody's paycheck, and at least they ought to have a heck of a lot of data about who we are and how much we make at any given moment, and where we all live and all the rest of it. So yeah, I think I think we're in a good place here for where to tell listeners to focus their efforts, rather than looking for a company that has AI in the ticker and has zero revenues and questionable ideas.
It's certainly been a roller coaster.
Yeah.
And I'm not fond of roller coasters, at least with my money.
Yeah. Well, so that brings me to another question that I always ask, all the folks who are kind of focused from the bottom up, learning about companies and industries. Do the top-down considerations inflation and what happens in the bond market generally, that kind of stuff, political developments. I don't know. Do those macro considerations play any role in your investment process?
I think it plays a role in my frame of mind. If a company is, and it depends on the company, if a company has a new technology that's critical to business success for other people, I don't think the economy really matters that much. If you look at data security right now, I don't, AI is actually creating as many problems in data security as it's solving. The criminal use of AI is incredible. So I don't see those companies as being affected. If it's a cyclical manufacturing company, I'm a little more hesitant right now, because you don't know where the economy's going. You kind of feel like inflation is going up, but you don't know that. So what I don't do is I don't begin with a macro view and then go find investments to meet that view. What I do though is I find an investment I think is a good idea, and I kind of reality check that against the macro environment to say, if the economy is going to contract, does this company still make sense or not? And that's where it becomes key.
Right. Yeah. It's critical in some in some industries where, like you mentioned, manufacturing. If it's got a cyclical economic component to it, watch out. But otherwise, yeah, there's plenty of businesses that are they're critical to our everyday lives, and they're critical to everyday lives of various other companies. I'm not going to stop using any Microsoft product because of the economy, right? Like nobody's going to stop using Microsoft Word.
One of those businesses, Joe, you worked at, right? In insurance, right? Which is one of our favorites at Stansberry. Dan just reminded me or told me 2 weeks ago that he was responsible for one of our long time picks, right? W.R. Berkeley.
Yeah.
What did you learn about investing while working in the industry? Because what's the big thing that you learned from your time?
Oh wow, that's a tough question, because I worked at a very special company. Okay. I worked at AIG, which was owned by a guy named Hank Greenberg, and we were the superstars of insurance. Nobody else had a AAA rating, and nobody would write the kind of insurance that AIG would write. What I did learn, which I think is kind of relevant in the discussion of insurance companies today, was that what AIG was really, really good at was underwriting and underwriting risk. And, in terms of back to my looking at the Russell 3000 and going through these companies, the opportunity I think in insurance and AI is underwriting, because it's their biggest cost of doing business. It's whether they pass or fail at the end of the day is how they underwrite the lines of business. And so what I learned at AIG, and what I think is still relevant today, is if you can underwrite really well, you can. I worked in the investment department at AIG, and Greenberg used to say, we take a lot of risk on the investment side, we take no risk on the investment side. I think we were the biggest holder of AAA bonds in the world. But that underwriting mechanism is very important, and it's a great way that AI can improve insurance companies' results. And if you look across the insurance universe, some of them are making huge investments in AI. I think there's one company I found this week that has appointed a chief technology officer that comes directly out of AI development. So that tells me that it's critical for them.
I have to ask if were you there during the financial crisis or no?
No, I left in long before that. I left in 1993, so I was long.
For a minute, I thought that was going to be a story about what went wrong.
But actually, it's interesting. Shortly after I left the company, I reported to the chief investment officer, and he passed away several months after I left. And that's when Hank brought in the financial products people, and that whole business took off. So that all started right after I left, but it wasn't going on while I was there.
I see. All right, you're off the hook. We'll let this guy go. All right. So at this point, I have to ask if there's a particular company that you're willing to share with our listeners. If not, I understand some people are, they have to protect their process for their subscribers. But is there a ticker you could share that you're particularly excited about these days?
Happy to share one with you, which we've recommended before, and I think is just a fantastic company that kind of everyone should know about. And it's a company called Interactive Brokers.
Oh yeah.
Some of you may know it, some of you may not, but Interactive Brokers is a broker dealer, obviously, primarily for hedge funds and people who trade a lot and borrow a lot of stocks. But they've also moved strongly into the retail market as well. And they have a very, very sophisticated platform. They have they're 100% automated. They have the highest margins in the business. No one even comes close to them in terms of their operating margin. And it's also an AI play because they're using AI from beginning to end to manage their customer experience. I don't know if you've ever had an account at Interactive Brokers, but basically the one thing you can't do with them is get someone on the phone to help you. Everything goes through an automated customer service system that is second to none. And I would add, that may not sound like a great thing, but their customers are very happy and they're growing explosively. Besides all of that business, which is doing very well, they also have a betting business, which they've been kind of fermenting for a couple of years or growing for a couple of years. And that's where you bet on, you place a wager on whether it's going to rain tomorrow or whether the Red Sox are going to win a game or all these kind of things. And I see that as kind of a wild card. And I think they're an interesting company in that business. I'm not exactly enamored with the business, but I think they're an interesting company because they're operating at some 40 or 50 companies, or I'm sorry, operating in some 40 or 50 countries around the globe now. So they have a lot of scale that their competitors don't have. So that's a very interesting company to me.
Glad you mentioned this. My wife actually was the one who told me that they had gotten into the the betting market, and I have to say, if you had asked me to pick likely companies likely to get into the betting market, I think that would not have been on the list. It frankly kind of shocked me.
Yeah, it does. I mean, I've heard their ads. They advertise the financial trades that you can make. But yeah, I would think too, like when Robinhood added sports betting, that made sense to me from that.
Yes,
that made clear sense. But yeah, but I guess a company like Interactive Brokers doing essentially something similar, but
yeah,
maybe
that's a cherry. That's a cherry on top of a great company doing other wonderful things each and every day. And so you kind of got a wild card, what I call a kicker, with that.
Right. Yeah. It is. It was. I suppose I should just leave it at unexpected and not try to say, has the culture changed? I mean, the same guy's been in charge for some time, and it's just well known that this is a very high quality business. Good culture, good management, et cetera, et cetera, et cetera. And the founders still there.
I would say if you think about the amount of risk they have to manage on a daily basis, they're dealing with, they're the counterparty to highly leveraged hedge funds.
Right.
So the amount of risk they have to monitor on a daily basis, I would think has got to give them some sort of leg up in that betting business, which is kind of the same thing. So we'll see.
Yes. And if anybody wants to take that as a statement on what hedge funds are doing at any given moment, I'm kind of with you, I think. Great, IBKR, and is this like, this is just a great business that you think people ought to know about, or you think it's a particularly attractive thing now, or maybe just that cherry on the top makes it more appealing now? How would you characterize, like, right this minute, your view, buy, sell, hold, it's interesting, keep an eye on it?
I don't know what's going to happen in the market tomorrow, next week, next month, or in the next 6 months.
Right.
I think probably
Right.
other people have much stronger opinions on that than me. I see Interactive Brokers as a kind of company you can buy tomorrow, and if you wake up in 3 years, I think you'll be doing fine.
Okay.
A solid
Good. Yeah.
business, and who knows what's going to happen in the world tomorrow, but it's not the kind of company that's going to go away. That's my view.
Not going away is an extremely important thing. Not failing. People don't appreciate how important not failing and not losing and not making mistakes is.
You're buying a strong and solid business. I think if you buy a weak business in this environment, you're making a very risky decision. And as I said, who knows what's going to happen tomorrow? But this is a company that's going to be around.
Yeah, and your advice there, or not advice, but idea of, it's a great business, high quality business. You could buy it tomorrow and wait 3 years. I feel like you've just summed up our Extreme Value newsletter that Mike Barron and I write. That's everything we do. It's like, well, we're not saying it's going to go up in the next 3 months or even 6 months, but it's got excellent long-term prospects. It's in a great competitive position, extremely important. And, good management, good balance sheet, lots of cash flow, lots of options that poorer financed companies don't have, et cetera, et cetera. So I hear you on that. Nobody's gonna come back in a month and say, "Oh, that Joe, he led us wrong." That's not gonna happen.
Thank you.
So, all right. How about industries overall? Like, we talked about AI and looking for companies, high quality businesses that are already good businesses that are going to make good use of it. But and you spent time at AIG, so we broke this topic of insurance companies. Do you think insurance is a particularly great business? Do you like, do you what? Actually, here's the question. Sorry, I could have formed this question much more quickly. As Warren Buffett might say, what do you see as your circle of competence? Put it that way.
My circle of competence is getting up in the morning and getting ready to do work. I don't know. I would say it extends. I've done what I've done for a long time, and I've been very blessed to have a career that I enjoy what I'm doing. I would say that as far as I would actually ask you, can I answer your question a little different way?
Sure.
I would say there are two industries where I've never really wanted to put money into. We talked about airlines earlier. I think there are more airlines gone bankrupt than as a percentage of the companies in business than any other. The other one I've always had difficulty with is banks. My dad ran a bank. I grew up in the banking business, and I know as much about banking as I think most people do. But when I go to look at a bank as a stock, you really can't see into their loan book. You don't know whether they've got Class A office properties or gas stations outside of Topeka, Kansas. You don't know what these loans are against. So it's always been very difficult for me to say, obviously JP Morgan is better than some fly-by-night bank in, I don't know, Idaho or something, but nothing against Idaho. But some are safer than others, but I just really, there's an opacity to the banking business that I've never been able to get around.
And if I'm really being honest too, I that really does exist in insurance as well, because in both cases it's the particulars of underwriting, right? It's particularly noticeable among the reinsurers, right? You have no idea what's in there, and they aren't going to share the underwriting parameters with you, certainly.
Yeah.
So you're basically assessing those companies. It's their history is really all you get, right? You can't look inside them. I've realized that banks and insurers, to to an extent, they're underwriting risk. They're underwriting loans. They're underwriting insurance risks, and you never get to look inside them. Reinsurers are a particular example, right? You just never get to look inside. You don't know what the reinsurers have zones where they write so much of their net worth around the world, and you don't know how they're drawing the map, as just one example. So, yeah, they're black boxes. I have the same problem.
Some people can focus. I have a friend who's a banking analyst. He's done it all of his life, and he can get them at it. That's a level of specialization I will never have. I'm more of like Peter Lynch. I buy businesses I like, I love, where I can touch it or feel it or understand it. That means a lot to me.
So you're a bottom up, but mostly a bottom up generalist who has a too hard pile, which Charlie Munger might say, right?
Yeah.
Some things are just in the too hard pile.
And there's so many good things to buy out there. Just be happy.
That's right. Don't be greedy. You don't have to do the banks, and you don't have to do the Greek shipping or the airlines. You just be happy with what you have.
Yeah, if you want to invest, it should be fun. It should be something you like, you love, where you think you're going to make money, and where you can understand where you went wrong. If you can't understand where you went wrong, you're never going to learn.
I'm glad you mentioned understanding where you went wrong. One of the most remarkable statements I've heard Warren Buffett make was when he was asked about, postmortems and how they think about investments that didn't work out. He essentially said, we don't spend any time thinking about that. We did the work that we did, and we went, we invested when and at what price and everything that we did. And that's what we do. And we recognize that it doesn't work out 100% of the time. And I think he saved me a lot of anxiety and a lot of time, because I've heard about people doing detailed postmortems. And I've thought, oh gosh, here's another big workload that I need to saddle myself with if I'm really going to do this right. And then I came away thinking, well, my process has actually produced a pretty good track record, and it continues to do so. Why would I worry about the few times, or even if it's 40 or 50 or 60% of the time? It's the magnitude of the gains, not the frequency. If the process is working and producing good returns against your benchmark, what do you care, right?
Yeah.
How much time do you really spend thinking about things that don't work out, I guess, is the question, Joe.
How much time do I spend about it? I will do a brief postmortem.
Mm-hmm.
I would say I like, you're a value investor, so you understand it. Value investors do all their risk management before they before they buy the stock, right?
Right.
Warren Buffett tell you that any business is a good investment at the right price. So you do your kind of pre-buy. But again, pattern recognition, you have to understand where you went wrong. So I think it's important to keep that in mind. But I also think it's a great thing to operate with stop losses. In every recommendation we make, we give a stop loss. And I think that's critical, because if you're down 30% in a stock, either you've made a terrible mistake or someone knows something you don't. And so I think at that point, it's a great idea to take a pause, make the sale. And when you do that, it gives you fresh capital to put into new ideas. I've always found that my best ideas, my new ideas, are my best ideas, or have the most potential. So when you sell, whether it's because you're successful or whether you're wrong, it gives you that fresh capital to put into new ideas.
Yeah, when to sell, man. That's a big one, isn't it? We all start out young and strong, worried about what to buy, and that's all we spend our time on. And then one day we learn that there's another part of this that's really kind of important if you want to keep the money you've made. So maybe we should ask you to address your sell discipline and how you make that decision.
Well, I think about it most on the downside. As I said, if you're down 30% in a stock, something's wrong, move on. Another way of looking at it, which a very wise and rich investor told me, if you're up 30%, sell a third and be happy. Don't be, don't think you have to own it for a specific gain. Some people like to work with specific price targets. I'm not that kind of person. I think it's, everything is an evolution of the idea. And as long as the idea is working, I'm fine to stick with it. But I also believe if you made 30%, sell a third and be happy. If you're up 50%, sell half, be happy. Keep that capital fresh, because two things. Number one, stocks that are up the most are generally the ones that fall the most. So you want to avoid speculation. And second, as I said before, having that fresh capital is for your new ideas. And go find, for me, the excitement is the hunt. So that gives you an opportunity to have money to go buy something else. I also believe if an idea is kind of working okay, that's fine. But if you find something else with a lot more opportunity, definitely go for it. Sell the bad one and go for the other one. Depending on what trading platform you're on, most trades are quote unquote free now. I know nothing is free, but if you're in liquid stocks, you can get in and out every day. So keep your portfolio fresh and make sure you're always on the best horses. That's a great thing to look at.
Yeah. These are
When I first heard somebody told me that something similar, sell half, and I was like, oh wow, I can sell half here. Like this is up until that point, I hadn't really thought of it that way.
The key and the hard part is to be happy.
Yeah. You can be half right or with that advice, you can be half right or half wrong and
find something else to
be
do.
Okay. Yeah.
I think Dan hit on, doing rigorous post-mortems where you sit there and cry in your oatmeal for a month is really not happy for anyone. And we've all made mistakes, and we all had investments that didn't play out as we thought. So believe in yourself. I don't know. Believe in what you do. Stick to your knitting, and if it's not working, move on.
Traders.
Eddie, here we are, and I always say this. Here we are once again, right, Corey? We always wind up here. Get rid of cut your losers, let your winners run. It's it's Jesse Livermore. He's in everybody's head.
But I want to say one other thing. You never learn from things you do right. You always learn more from your mistakes. So whereas I'm not for these huge postmortems, do remember what went wrong, and keep that in your pocket for future reference.
That's I think that's as well as you could put that. And the earlier comment about just being happy is the important part too. You want to do things that reduce your level of anxiety, not ramp it up like throwing good money after bad. Right? We want to reduce our anxiety so that we can continue to work our strategy in a systematic way. It's hard to stick with a strategy, isn't it, Joe?
I don't know if I agree with that. I've had a pretty good. It depends on what you mean by a strategy.
Well, if you found a method that works for you,
what?
You found a method that works for you, so presumably, like by this point in your life, it's not hard to stick with it. But I'm willing to bet most of the folks listening to us could tell me the times when they say, well, I'm this kind of investor, but on this occasion I held too long. I sent good money after bad, just all the usual mistakes. I think our core reader and subscriber at Stansberry, I'm willing to bet that they're nodding their heads when I say it's hard to stick with a strategy. You see your friends making tons of money buying something you don't understand, and you're like, well, I'll just buy a little, It's not hard for you to stick with a strategy. I'm not talking about you.
Okay. I'm just saying, for me, it's pattern recognition. The things that have worked for you in the past. Where they haven't. Tips for me have never been great. I got a hot tip. This one's really going to double, Joe. It's really going to double. I was a tech analyst, and everything had this, off to the right, up and to the right. Every trajectory was like that.
All right. That's what I'm talking about. That's not a strategy. Yeah.
It's not a strategy. It's
exactly.
But the real key, and you talk about your strategy, is less about the offensive elements of your strategy, but the defensive elements of your strategy. What things are you willing not to do? And I think, honestly, I've seen investors that I'm no guru on retail investor psychology, but I think that most people know when they've made a mistake or they've done something that's outside their comfort zone.
Yes.
And that's where you have to pay real attention.
Exactly. Via negativa. The learning of life is about what to avoid, wrote Nassim Taleb in one of his books. The what not to do, right? Charlie Munger often told the story of the fellow who says, I just want to know where I'm going to die so I can never go there, And it's a joke, but it's profound. What to avoid, because you take a flyer with a big chunk of your portfolio, you're YOLOing, as people have liked to say in the past few years. And, then you lose a big chunk of it. And now you've got the work of building it back up. Sort of like the gambler who bets it all to try to recover what he's lost. Terrible habit, terrible thinking, not the way it works. I'm glad you mentioned that. What not to do. Another thing that all the great traders and investors we interview always come back to, right? Risk management, what to avoid. Yeah. It's not sexy, but it'll help make you wealthy a lot more than, YOLOing half your portfolio in some speculative garbage, right? So, yeah. All right. We are at the moment when we ask our final question. And it's the same final question for every guest. Mark Shakin's answered it a couple of times. No matter what the topic, even if it were a non-financial topic, I would be about to ask you the identical question. If you've said the answer, feel free to repeat it. And it's simple. For our listeners, please, could you give us, Joe, just one thought you'd like them to take away? Just one thought today.
I think the main thought, and I forget who wrote it, but there was a famous book back in the 70s called The Loser's Game. You may know who wrote this book.
I think was it Charlie Ellis?
Yes, Charles Ellis.
Yeah.
And what Ellis talked about was what I call unforced errors. And I think his analogy in The Loser's Game was professional tennis.
Yep.
That professional tennis players win the game because they're good at it. And I think, and that people who play tennis casually win a game because they're lucky, or because they don't make a lot of errors. And you lose if you're an amateur tennis player. You usually lose because you didn't play a good game. And I think that's really true today, especially in the environment we're in. The stock market I see today is a loser's game. And it's avoiding unforced errors, sticking to your knitting, understanding the company, investing in businesses you like and understand is the most important thing. And that to me, that's been kind of my North Star of my the way I pick stocks and recommend them to people.
Ladies and gentlemen, we have a winner. That is one of the greatest answers. I love that book. I love the story about the tennis. I highly recommend it. It's called Winning the Loser's Game, and then there's a long subtitle to it by Charles Ellis, who is a brilliant guy who worked for Capital, I think, for many years. Thank you so much, Joe. That was a great final answer, and it's been a lot of fun talking with you.
Dan, Corey, thanks for having me here today. It's been a pleasure.
You bet. We'll talk again soon.
Yes, sir. Thank you. Bye.
Bye-bye.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.
2 decades ago, when I first studied deep neural networks, it was clear that AI would transform many industries. But back then, the technology wasn't ready. Today, it's finally reaching its potential. Artificial intelligence presents significant opportunities for asset management, but one thing hasn't changed. AI is only as smart as the people who guide it. First, AI refines the way we analyze investments. Machine learning helps us find patterns in huge amounts of data. We can take thousands of research reports and analyze them in seconds. And automation gives our teams more time to focus on what really matters, developing solutions for our clients. We use data and AI to transform how we research investment managers and build portfolios. For example, our tools analyze over 10,000 equity investment products using detailed data such as portfolio characteristics, team changes, risk exposures. But data is only part of the picture. We combine AI's power with our team's experience and deep understanding, because the real wisdom in investing comes from knowing the story behind the numbers. The future isn't just about artificial intelligence. It's about enhancing and improving how we apply intelligence.